Welcome to episode 2 of Export Exchange, Usdec's video series designed to keep you up to speed on dairy markets. I'm William Laux, and I'll be joined shortly by my colleague, Al Levitt. This episode will provide you the usual update on broad U.S. market conditions before Al discusses what's happening in skim milk powder, non-fat dry milk stream, and what to watch for moving forward. Let's get right into it. Last episode, I talked about how COVID-19, food service, and school closures, and a whole lot of milk all transpired to push down dairy prices, but with farmers cutting back on milk production, they were on the long road back to recovery. Turns out, it wasn't that long of a road after all. In order to avoid an oversupply of milk, cooperatives independently instituted programs to reduce milk production, and farmers responded. You can see here on the graph, looking at the gray line, that U.S. milk production fell by 1.1% in May. That's a sizable decrease in U.S.'s peak month of production. That also comes after April, which although the data shows milk production grew, about 1% of it was dumped as a result of there not being a market for that milk. This graph also shows how farmers were able to cut back production so fast. The purple bar shows the year-over-year change in U.S. milking cow herd. Here we see that the U.S. herd was 37,000 head larger than last year, so that wasn't the reason. Instead, the lighter blue bar shows the year-over-year change in yield, which declined by 1.5%. That almost never happens in the US, and it wasn't because of any sudden weather event or changes in cow genetics. It was because farmers adjusted rations, reduced milkings, and instituted other practices to slow the milk supply. That also means that US farmers, because they're very good at what they do, will be able to turn on the taps again as the herd remains fundamentally intact. Still, for markets today, it's important to remember that milk production was down in May and is likely still down in June, though we don't have that data yet. That contraction also came as Americans began going out to eat again. We have on this chart data from OpenTable, an online dining reservation platform, showing how much dine-in service is happening in the US. You can see pretty clearly when the lockdown started as customers ceased going out to eat, which led to that precipitous drop in food service we touched on last episode. But since early May, consumers have started venturing back out, even though it's clear we're still a ways from normal. Yet, food service buyers needed to refill their pipelines quickly to be ready for customers, so they were needing product fast. Add in retail demand for dairy staying high and the US government stepping in to ensure the vulnerable in the US were fed, and you've got a really fast price recovery, as you can see on this chart. Things will surely have changed from the time I record this, as we are in a period of unprecedented volatility and uncertainty from COVID-19. But I do want to harken back to something I mentioned earlier. US dairy farmers are still very capable of producing more milk since the herd remains intact. It's just a matter of when the US returns to growth, rather than if, which will return the market to a better balance. But even still, the takeaway I want to leave with folks is that what's happening today in dairy markets is demonstrating that a robust risk management strategy can help your business manage through the volatility and uncertainty while ensuring that you have adequate supplies to meet your needs. Now, let's turn it over to Al for our deep dive of the week on S&P and non-fat and for the main factors to watch in the months ahead. Al, what do you have for us?
Thanks for that update, Will. Today I want to expand a little on our powder supply, chiefly non-fat dry milk and skim milk powder. The United States is the world's largest single-country non-fat dry milk skim milk powder supplier. We produced more than 700,000 tons last year. And since most of that goes to overseas customers, we're also the world's largest single-country exporter. But the powder market has taken a couple twists and turns this year. Taking it back to the end of 2019, with the overhang of EU intervention stocks out of the picture, the powder market took off in the fourth quarter last year, and it seemed poised to keep going higher at the start of 2020. But after the pandemic began to spread in February and the world locked down, the market reversed course. The big driver, I think, if you go back a couple months, people were looking at lost sales of cheese and butter and fluid milk when all the restaurants and schools closed. And at the same time, you had more milk coming on with the Northern Hemisphere spring flush. So suppliers were pushing much more milk through the dryers for longer storage. We also all thought EU powder would flow in intervention again. And then there was fear about the economic fallout in some of the key milk powder importing countries like Mexico and Algeria. And so we saw the powder price fell $900 to $1,100 a ton from January to April. Since then, though, we've actually seen a pretty impressive rebound. Turns out cheese and butter sales weren't as bad as we first thought, and the volume of milk that went for processing was a bit less than we expected too. And then the price drop on powder seems to have unlocked some demand to refill pipelines, especially in Southeast Asia, Algeria, and the Middle East. And as always critical, China has continued to buy, reporting March and April imports up 8% versus last year. You can see in the last 8 weeks, prices have regained about half of what they lost. They're up about $400 to $500 a ton. Either way, though, throughout the year, U.S. benchmark non-fat prices have been about $200 a ton less expensive than European SMP. So let's talk about what's happening in the United States. Powder production in the U.S. is running at an all-time high in 2020. Combined production of non-fat and SMP was up 3% in the first 4 months of the year, with record production in April. However, we do see processors making more non-fat and less SMP. And we really saw this play out in March and April when non-fat production was up 8% and SMP production was down 14%. So we had increased production combined with a decline in domestic use, and that sent U.S. non-fat inventories skyrocketing this year. At the end of April, stocks were at an all-time high at 178,000 tons. That's up 41% from last year. And just since last November, stocks have increased by 77,000 tons. But continued commitment to export customers has kept U.S. exports flowing. U.S. powder exports are up 15% this year and just shy of the record volume shipped in the first 4 months of 2018. April volume was up 20% with record sales to Southeast Asia and Japan, more volume to the Middle East North Africa region, and even improved sales to China. So in short, when it comes to non-fat and skim milk powder, U.S. production is strong, inventories are ample, and U.S. prices are competitive. So let me wrap up. Like William said, the markets are in flux and there's a great deal of uncertainty. And I think the key factors to watch going forward are what happens with milk production? Are farmers going to react to higher prices and turn on the taps again? Also, are we seeing a shift in global inventory management? Like, how full are pipelines and how much have companies bought ahead to hedge against the potential supply disruptions down the line? That's going to shape imports going forward. And lastly, of course, COVID-19 is going to have the last word. Every region seems to be at a different stage in controlling the virus, but will there be a second wave later this year? And if so, will we see the same sorts of lockdowns that we saw earlier? That's probably the biggest variable of all. In the meantime, on behalf of William and myself, we appreciate you tuning in. Thanks for watching, and we'll see you next month on Usdec's Export Exchange.